Welcome to today's webinar. This is the first in a series of basically webinars we're going to have called the Investor Power Hour here at Disrupt Equity. My name is Tarek Moussa, and I will be the host of this webinar for today. And in the future, we'll have special guests in the future. And to give some context about kind of what this Power Hour is supposed to be, this is basically a monthly webinar series that's designed for investors, and it's intended to serve as a dependable forum to help gain insights and understand and learn from industry experts and be able to ask your questions and ultimately cultivate meaningful connections in this game of real estate and investing that we all try to participate in and want to grow in. So with that, let's kick things off. So first webinar of the day today is basically how to buy or invest in your first real estate deal in today's market. And like I mentioned, my name is Tarek Moussa. I'm with Disrupt Equity, head of the investor relations team here and capital raising. So pretty qualified. My background's from the finance world. Used to work at BlackRock in New York City, so have a lot of experience in the investment world for many, many years now. So today we're going to cover basically how to invest in your first real estate deal. And today we're going to basically go down the list of basically why investing in real estate and why we recommend that. What are the 5 pillars of real estate and how we define those, and how to invest in real estate in general, and then how to choose specifically a location, whether to go with something like single family versus multifamily versus potential other commercial real estate asset classes, how to find potential real estate deals, and ultimately analyzing the real estate deals, securing the financing, getting those properties rented, and ultimately the operational piece of the deal. And then finally, how to invest passively if that's something you're wanting to do, and then what steps to take from that point on. So first and foremost, why real estate? Real estate ultimately is our bread and butter and our drug of choice here in Disrupt Equity, and we've invested in all other asset classes, the stock markets and so on, like many people. And also we found that real estate really was the one that was the most attractive and where we want to double down and scale up significantly. So part of the reasons why are the what we call the 5 pillars of real estate. Real estate, and what makes it such a powerful investing vehicle is that it has, number one, rental income, which is pretty straightforward. It's basically whenever a tenant lives in your property, they pay you rent each month, and that is obviously rental income. And that rent can then be used to do number 2 here, which is pay down the mortgage, right? You use that rental income to pay down the mortgage, which reduces your principal balance in the deal. 3, in real estate, you also get depreciation, which ultimately the tax deduction against your capital gains income, your taxable income, which ultimately, of course, reduces your taxable amount that you owe, and your net worth increases thereafter. And for those who don't know, single family, I think the default is basically it's 27 and a half years now, and for commercial, it can be 25 or 25 years or less, and you can actually accelerate that to where you have the vast majority of depreciation in the very first year, which is a special tool that we have these days. And then the fourth benefit, the fourth pillar of real estate is appreciation, basically the increase in value of real estate over time, right? And lastly, leverage. Part of what makes real estate so attractive is the fact that it has some of the best leverage out there. You're able to get basically 50% in things like the stock market or other kind of assets, but in real estate, you can go as high as 80, even 97% leverage in some cases with these deals, which ultimately compounds the returns you could otherwise achieve directly. So the steps here to take to invest in real estate. First and foremost, of course, you got to choose a location. And second, once you chose a location, is to choose an asset, and that could be single family, multifamily, commercial real estate. And really, in this case, we're probably going to talk about more of the single family because it's more familiar with people, but everything we're saying applies to multifamily and beyond as well. 3, find and analyze potential deals in that asset class. 4, secure financing. 5, close on the deal. And lastly, attract tenants, manage the property, and start collecting rent. Basically, the operations of the property and letting the actual investment begin to produce a return. So firstly, how to choose a location. Well, there's obviously many steps here and many variations, but some of the ones that we like most are, firstly, let's research the local market trends. Get online, see what people are saying about it. 2, evaluate economic indicators. Actually get on some of these finance websites, ultimately see what the reports and the analysts are saying out there. 3, make sure you consider neighborhood demographics, right? Some parts of town you want to avoid this side of the road versus that side of the road, or this side of the highway versus that side of the highway, or some places that maybe are not as attractive as other places in the city. And part of that, of course, is the infrastructure and amenities that come along with what the city is offering. Some places there may be a nice park. Other places there may be kind of let's say a oil development or refinery, something maybe not as attractive to live around or to invest around. Of course, you want to make sure you understand the laws and regulatory environment And from there, actually go and visit the potential locations physically in person, right? I think a lot of people these days, they like to defer everything to be online or kind of work from home. And that's great to a degree. But when it comes to investing, say, millions of dollars or a lot of hard-earned money into something like real estate, the beauty of real estate is that it's tangible. So you can go out there and actually see how is the area, how is the exact property that you're looking at, and how is the surrounding area and the folks around it and so on. Is this an area that you see improving over the next coming years in the future, or do you feel like maybe it's not going in the right direction? And ultimately, what we're talking about is really something called the path of progress. And the further you can be into, or the more deeply you can be in the path of progress to how an area or a city is developing, the better, of course, the expected returns can be over the long term. And if you're not familiar with all this and how it all works, a good place to start, frankly, is talking to brokers and realtors, right? They'll know generally how the city breaks down, how an area breaks down. Ultimately, don't know, hey, this area is probably worth looking at. This area, maybe it's not really going the direction that you're going to want it to go for the future. So that's a great start for that for the location. Now, when it comes to choosing an asset class, how do you decide between single family versus multifamily versus other? Well, let's just break it down, right? Single families are something that are probably a little more affordable. They're basically at the homes everybody lives in, right? They're more familiar to most people. Most people grew up in some, or they know people who have grown up in some, or spent time in them. So it attracts a wider range of buyers and renters out there because again, there's just so many more of them. But then multifamily properties, or basically otherwise known as apartment complex, they offer advantage of basically generating multiple rental income streams from one location, which ultimately provides more stability during market fluctuations. With a single family property, if a tenant moves out, obviously you're not making income on that property. Whereas in a multifamily property, you have many, many other tenants at that property who can still supplement the income if you have one or a few tenants that do move out. Now, commercial properties are often a larger upfront investment, and they tend to require a little more sophisticated management depending on what asset class we're talking about. And they come with usually less individualized risk than single family properties because you have multiple tenants that can supplement each other's income. And ultimately, you can make money in anything, right? And this goes in real estate and out of real estate. But ultimately, the choice between whether you want to invest in single family or multifamily or other commercial properties should be something that aligns with your personal financial goals or your investors' financial goals and your risk tolerance and your management capabilities. So how do you actually go about finding potential real estate deals? Well, of course, like anything in life, it helps to know people, right? So we recommend going out there and actually building a strong network of who? Of course, there's brokers, realtors, wholesalers, other folks that know how to play the game of real estate, right? Even your friends and family, folks that know people who own houses or properties that may be looking to offload or partner up with people. Related to that, of course, is to engage in local real estate communities. If you don't have people in your network already, then go out there and look for some. Most cities out there have an REIA kind of group or similar kind of meetups, real estate investment associations, with folks that are like-minded, that are looking to do similar things, that want to do deals together and so on. So we encourage you to go out there and actually find these groups and people and build relationships with them. And along the same vein, of course, go out there and attend meetups and attend investment conferences. Again, same people in the room together, right? And connect with other real estate professionals, like I said, professionals that are actually doing real estate, not necessarily the tax categorization of real estate professional, but professionals like realtors, brokers, people who do accounting for real estate individuals or attorneys and so on. Connect with folks that might be able to basically know somebody who has a deal or can find a deal directly and work together on for your benefit. And of course, not to discount the online world. Of course, these days we're in 2024. You cannot go out there and actually leverage online platforms to help identify distressed opportunities, right? Things like Redfin, like Zillow, and so on. There's huge resources that are wonderful to utilize. And of course, once you actually have some of these properties you want to find them, you can actually go out there and do direct seller outreach. If you see a property that looks kind of unkempt and deteriorated, you can actually reach out to that owner directly. Either knock on the door, give him a call, shoot him some mail, and you can do this at scale with some of these lists that some of these brokers out there have that fit certain demographics that may be more willing to actually sell you their property, and ideally for an attractive price, of course. So once you've found a property, of course, the next step is to analyze the property to determine, is it even a deal, right? So how do you do that? Personally, go out there and you have to research the comps in the area. Comps, of course, for those who don't know, means comparables, meaning comparable properties. So you take the data for comparable properties and you run the numbers and make sure that you account for all of the expenses. And it's preferred to be conservative rather than being a little kind of liberal or extreme here and underestimating what costs and expenses could run you. And from there, calculate what the return on investment will be at different price points that you may offer, right? If a person requests $300,000 for a property, let's just say, and you find that that doesn't really make sense, doesn't really give you a return that you're looking for, well, at what price would it make sense for you, right? Would it be 200,000? Maybe they'll take that offer, maybe they won't, but it's worth at least asking. There's nothing to lose when you do that. So find the numbers that are attractive to you and submit an offer at that price that satisfies your targets and see what they come back with, right? You'll never know what person's going to say. We've seen some crazy deals out there, both in the residential as well as commercial side. So it's worth trying, and it really costs you nothing. And part of this, of course, you want to make sure that you look at the rental income, subtracting out the mortgage, but make sure you also factor in the cost of property management and repairs and maintenance expenses. There basically see a property can generate, let's just say $2,000 a month in rent, and your mortgage maybe $1,500, and you think, wow, awesome, I'm gonna make $500 a month. But that's not the full story, right? The more important pieces here that people tend to leave out oftentimes are the other expenses that are going to be incurred, such as property management, paying somebody for you're not going to do it yourself, as well as repairs and maintenance costs. And frankly, even if you are going to do the property management yourself to start, that's a good way to get started. That's fine. But I encourage you to still set aside in your budgeting, at least, as if you were going to pay a third party, because at some point when you scale, the goal should be to grow and scale your portfolio. You're going to want to eventually offload that to a professional management company and get yourself out of the picture. And if you were profiting while you were doing it, but you're not going to profit when a property management company does it third party, well, then you're never going to be able to offload this and grow your capability. You're going to get stuck at the ceiling pretty early on. And some great resources, some data for software and data that you can utilize in this effort are, of course, things like Redfin and Zillow. Definitely encourage you to befriend a realtor, because they can actually go out there and see what have properties actually sold for, and at what point in time to ultimately determine what a certain property may be worth in an area. And then another great resource is a website called www.rentometer.com or rentometer.com. And that's a place where you can go and ultimately see what are certain kinds of properties and unit sizes being rented for in a given location. And it's really nationwide, which is what's great about it. So you can determine if you have this property that you're eyeing, how much rent can you really obtain in that? If you find that maybe Rentometer shows that the market is renting it for $1,500, but you have a current tenant there for $1,000, well, then, that's an opportunity for you to go out there and increase the rent. And ideally, you'd give some sort of benefit for the tenant to want to give you the higher price point. Of course, make sure it's equal to the comparable properties in the market, but that's a great resource to go out there and ultimately get that data so you can make those decisions. The next step is to go ahead and actually secure financing. That's most people are not buying these cash, or if they are buying it cash, usually getting that cash from someone else. So go out there once you find a deal and research financing solutions that basically are suitable for the deal that you're looking for, and then find out what kind of mortgage options are available for that opportunity. And once you identify what the financing options are, you can basically calculate how much cash you're going to need to bring to the closing table in order to actually close on the deal and finalize everything. And once you know what that closing table amount is, that closing payment amount is, then you can decide whether or not you're going to be the one to fund it yourself for that down payment or for that closing amount. Or if it's a larger amount, say like multifamily real estate, where we bring millions and millions of dollars to the closing table, we've brought as much as $57 million of cash to a single deal. And that's just for the closing on our part, excluding the financing. Then that's not money that we're bringing out of our own pockets alone. That's money that we bring with investors. Basically, pull a bunch of investors together, and we collectively fund that down payment. So determine how you're going to be able to fund that based on the financing options that are available for your particular deal. And then the last steps after this is going to be, of course, to close on the deal, get tenants in the property, start collecting that rental income, and then have somebody actually manage the property, basically all the little day-to-day operations, things like tenants, termites, toilets, maintenance requests, and so on, and ultimately start cash flowing on these deals and getting return on your investment. But it all is easier said than done, like everything in life. So also got to take into consideration, what are the risks of investing in real estate? And of course, number one, everyone's heard of real estate being number one, top three things in real estate being location, location, location. Well, of course, one of the risks investing in real estate is choosing the wrong location. And realistically, a bad location can ruin an otherwise great deal. So you want to be very careful not to invest in a bad location. And the good thing about real estate, it is generally pretty forgiving over the long term, but you still generally want to choose better locations that ultimately give you higher returns at a faster pace rather than the alternatives that could be less attractive. And of course, another risk of real estate is overpaying for a deal. You make money on the buy, meaning that if you analyze your numbers on the front end and you buy an attractive price point, well, then that is how you know you're going to make money on this investment opportunity. If you overpay, it's pretty darn hard to climb out of a hole if you've overpaid and you're stuck in that hole. You may have to wait a much, much longer time to get a return. For example, this is the deal I've done, and in the first year, we generated more than 100% return, which is phenomenal. But then if I had actually paid what the seller was asking for, 5 years later, probably would still not be breaking even on my investment. So overpaying is a very critical selection in terms of making sure you don't do that in terms of the risks of investing in real estate. And of course, other investment risk of investing in real estate is having a lack of time or knowledge of the property management space. Property management is not necessarily an easy game. It's easy when there's only a few properties here and there, but as you scale larger and so on, it can be tough, and you can have some really big headache tenants who just make your life miserable. So you want to make sure that you understand how the game is played and make sure you have the systems and processes and so on. If you don't, that's fine. There are plenty of third-party management companies that do have this stuff, but make sure you hire someone, of course, who knows what they're doing, and they do have the time and the knowledge to take care of the tenant, make sure that they're satisfied so that they can ultimately fulfill on their obligations, which will result in a positive return on your investment, hitting the targets that you anticipated. And then lastly, another risk is getting stuck investing in smaller properties that don't really produce enough cash flow. I think that these smaller dollar amounts, people see these properties that are these days, you may find some in some markets that are selling for $100,000 or even less, right? I've seen properties as little as $10,000 or $15,000, which is ludicrous. And you think that, wow, how can you lose when you have a price that's that low? And it feels more comfortable. It feels safer just because most people don't have millions or billions of dollars to invest. But the problem with these small properties is that they're usually priced at that price point for a reason. So you want to be careful not get stuck buying yourself a problem that's going to be persistent for the long term. And ultimately, our recommendation is to scale. And when you scale up, you can start with one property, two properties, small ones, and just get comfortable. Make sure you actually know what you're doing and not going to get yourself into trouble. But whenever you're capable, we encourage you to scale up much larger. We bought a large multifamily property, I think 140, 150 units on our very first deal, and sounded like a ton of money and work. And we did not fund that all from our own pockets. We did that with investors. But the nice thing about having some of these bigger properties and having more cash flow is that whenever you have smaller deals, you get stuck in the day-to-day operations of the property, right? You have to sit there and go have every request or issue or work order go through you individually. And you're stuck spending your time there the whole day. You don't really have time to work on building the larger business and expanding the portfolio and finding opportunities beyond this property and this deal. So there's a risk that you run by staying small. But if you want to grow bigger and actually increase your wealth substantially, then we encourage you to go for larger properties, which ultimately are not that much more risky. And they don't really require that much more work. It takes a lot of work to buy any property, but the level of work that's required to buy a small single family property versus to buy a large multifamily property or a large commercial asset, they're not much different. It's probably a few percentage points different. So we encourage you to spend your time and get the most out of the time that you do spend by going larger. So all this sounds like a lot of work, right? But the beauty of real estate is that you can get all these benefits that we talked about without all the work of having to do it yourself. And the way you do that is by investing passively. So what does passive investing even mean? It's basically a way for you to generate passive income without the day-to-day stress that comes with real estate or any investment, frankly. And the way to do that is by partnering with an operator and investing in a deal or a syndication, as it's sometimes known as, with other investors. Syndication is just the combination of funds from multiple investors, which you then use to go and buy a property or an investment opportunity. And this basically avoids the headaches of property management, like the day-to-day things that are more popular, like dealing with tenants and termites and toilet issues and so on. So it's a very attractive way that a lot of people, frankly, most people out there really get some exposure to the real estate world through this vehicle. Now, who is Disrupt Equity in our company, right? This is our company, Disrupt Equity. We are a multifamily real estate syndication company. We cut our teeth in the single family world individually and eventually grew up and started expanding into the multifamily world. And at this point now, we partner with investors to provide high returns for their investments, their funds, and ultimately allowing them to benefit from the benefits of real estate, those 5 pillars that we talked about earlier in this presentation, as well as the tax advantages that come along with real estate. And at this point, we've purchased right around $1 billion in assets to date. whatever is short livestock. So it's great. And for deals that we have gone full cycle exited on, right? Not just theoretical numbers that we hope to achieve. These are numbers that we've actually achieved. So far, we've produced 50.6% average annual returns to investors. And that's net return to them after all fees, splits, and everything. And part of that is the fact that we are a vertically integrated company with in-house property management as well. So we have full control of the deal life cycle and can keep a pulse on things and make sure we pull the right levers where appropriate versus having to defer to a third party who really isn't incentivized or doesn't have aligned incentives to make sure that you can get the best return on your deal. So what are the next steps for this point? You at this point know basically how to buy your own deal, and a lot of nuances to this, but ultimately you know what to do and take the next steps. And as you begin your journey, you're going to learn a lot along the way, of course. And from here, you can basically go out there and start finding your own deals. Or if you feel like it's a lot of work, it's kind of tough and it's not for everybody, you can alternatively invest passively with a trusted operator who will do the hard work and handle the day-to-day operations of this process that we talked about. And I encourage you to visit our website at www.disruptequity.com/invest and go ahead and sign up to get notified of our newest investment opportunities as we find them. Like I said, we play in the multifamily space as well as a few alternative assets too, but it's super interesting, and I would love to have you take a look at our opportunities and see how they work, what we did, why we chose them, ultimately decide if it's something maybe you're interested in participating in yourself. And if you have any questions at all, you want to speak to our team, get your questions answered, learn how we can help you achieve your financial goals, I encourage you to shoot us an email at invest@disruptequity.com. So with that, hopefully that was helpful, everybody. And I'd like to open up the floor now for some Q&A. If you have questions, please, on your screen, you'll see the Q&A button. Go ahead and click that and enter your questions there. And we'll give it just a second to let them start coming in. All right, so here's a good first question, which is, what red flags should investors be aware of when reviewing deals today? Well, obviously this time we're in late 2024. We have an election right around the corner, and the world has completely changed in the real estate game since a couple years ago. First thing that we would be cautious of as a red flag is looking at the loan of value that people take on. There's the leverage that they take on some of their deals. In the past, you would hear people take on leverage of 80, even upwards of 90, 95% leverage, which is awesome for the returns that you can get. But the challenge is, of course, that only works if the deal goes the way that you're expecting it. If you happen to hit some road bumps and things don't materialize the way that you're anticipating, well, then it can also work against you in the opposite direction. So you want to make sure that you're not getting overly aggressive with the leverage, and that it's somewhere that's tenable, and the pro forma, the basically the cash flows of the property can sustain those figures. And of course, what ties into all this, of course, is make sure that there's a sponsor who has a good track record, and they know what they're doing with actual results to back it up and not just aspirational targets. And really related, of course, I would also touch on basically having overly aggressive underwriting assumptions, things like rent growth or population growth, and making sure that they're reasonable and believable versus maybe someone getting crazy and thinking that, oh man, I want this deal to have a massive basically growth in the population, which of course would result in awesome returns for your investment, but it may not be realistic. I think there's a awesome term I heard the other day, which is ROE, which is return on Excel, right? Basically everything can look good in the Excel model, but you also got to make sure that the data on the Excel model is accurate, believable, realistic, and attractive so that you can actually hit the targets that you're looking for. And maybe the last thing I'll answer on this point is just making sure that folks, whoever is analyzing the deal, accounts for the world that we live in today, which comes with, frankly, higher taxes and insurance. We've seen some people more recently kind of underwrite to data that was realistic, probably in a market of 2001, 2002, sorry, 2021, 2022, basically a couple of years ago, where things were lovely and the whole market was flying high. But these days, we've had obviously interest rates increase. We've had a lot of challenges with inflation and so on. So what does that result in? It's in higher taxes and insurance that we've had to deal with. So obviously nobody wants to deal with that, but it's something you should definitely account for on the front end so that it doesn't catch you off guard on the back end by surprise. Great question. Going back to their board again. Let's see. Here's another question that kind of relates to this, which is basically, how has your underwriting changed? Well, kind of like I alluded to, which is just a moment ago, we are planning for higher Texas insurance these days than in the past. And depending on what markets we're talking about, places like Florida, for example, we expect insurance costs are not going to fall there, but in other places like maybe closer to Texas or inland in the country, those market premiums we think are actually going to probably come down in the near future, just because I think there's an overcorrection always that takes place. But we are in general planning for higher figures for those expense items. And then we are accounting for higher unit turn and construction costs, meaning that whenever tenants leave and you got to turn the unit for the next tenant, and actually do any sort of construction on the property, prices have gone up, frankly, across the board. So we're making sure that we're not expecting, let's say, like $8,000 per unit turn. Now we're probably pushing it closer to $12,000 to $15,000 per unit turn. So make sure that we're looking at the market accurately as it stands today, so that our projections are in line with reality and ultimately our returns can be realized appropriately. And then maybe the last thing I'll say is just that we're also focusing on cash flow more than appreciation. And we've always focused on cash flow primarily, but I think it's just worth doubling down on that effort to make sure that whenever we buy a deal, it's a deal that is actually cash flowing versus a deal where we think that, okay, we're gonna make an awesome net return on the exit, but realistically, the sale price at the exit may not be as high as we otherwise would have seen a couple years ago. So it's more important to make sure that there's some cash flow to that you're not going to get into trouble with your deal. Okay. Another question is now really the time to invest given the lull in the real estate market? Candidly, I think the answer is yes. I mean, frankly, it's not, I think it's definitely a yes. Frankly, we've been waiting for distress in the market to happen for quite a while. Post-COVID, everything shot up and obviously interest rates climbed thereafter. And that really squeezed a lot of people. A lot of people found themselves in trouble where their initial purchases were based off of basically poor underwriting assumptions, or we're hoping that the market was going to stay flying high like it was at pre-COVID and so on. And unfortunately, that's just not reality. Everything is cyclical, especially in the economic game, including in real estate. And we have been waiting for the distress that people were basically finding themselves in from those changes in the market to start materializing. The banks and lenders, they were able to kick the can down the road for a long time. It did some loan modifications and so on. But for many people out there, many deals, many banks, they basically have run out of runway. There's not really much more room to kick the can down the road, and they have to either bite the bullet or just take the loss. And what we're finding now is that we are starting to see those cracks in the system materialize, which is what we've been waiting on. We've been kind of not sitting on our hands, but just waiting patiently on the sidelines to see the great deals come through. And we've started to see that in our previous deal and our current deal. That distress is basically forcing sellers to offload their real estate deals at extremely attractive prices and extremely attractive terms that we otherwise have not seen in a long time. So that's got us excited, and ultimately we think that this is a great time to invest in the real estate market, especially when you can find these kinds of deals. I wouldn't buy a normal deal necessarily right now, but if they didn't have some sort of distress opportunity, I'd be a little patient with that one. But where there's opportunity where a seller is being forced to take action, in a deal they otherwise would prefer to hold on to, then that just means that it's a great opportunity for the buyer. In this case, we are active buyers. So definitely think it's a good time to invest. And what kind of demand are you seeing for multifamily? I think it's a tough question, but I think realistic answer, no matter what point in time over the last century you've asked this, is that it is a good time. There's always demand, frankly. Housing is still a huge issue in the United States, right? And multifamily is kind of the darling of the commercial real estate world, just because one of the three essential needs for anyone's human life is what? Food, shelter, and water. Well, we take care of the shelter piece in this. So there's a huge housing shortage in the US. Obviously, a lot of people are trying to do a million different things to solve that problem, but how many of those are real or going to have a real effect is anyone's guess. And I think it's a problem that is still a far way off from being solved. So the demand is huge. We're seeing it still across the board. And I think that the housing crisis is not going to be solved anytime soon. So we're still super interested and love it. That's frankly why we even got into multifamily versus a lot of the other asset classes that we saw in the past. Things like office, for example, when everybody started work from home, they just got destroyed. Offices still struggling and trying to recover, but it's going to take some time. They've had to start taking a lot of losses to accept it and just move on. That's just reality. Hopefully that was helpful for everybody. And that you enjoyed this webinar, and you'll join us for next month's webinar.